Hey, and welcome to this latest weekly market recap for the week ending Friday, December 12th, 2025. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com. It's a pleasure to be with all of you this weekend. We got a few more weeks to go till the end of the year. Market, S&P 500 made another run for 6,900. We got an all-time high close this week, but things under the surface still not looking great. We saw a big turn to the downside on Friday to close out the week, so it wasn't all great. We had, like I said, pretty decent week. We got the Fed out of the way. Fed did lower rates, actually restarted QE, so had some pretty good news there. Money definitely rotated, as you might expect, towards some of the rate sensitive areas like the regional banks, like small caps, home builders, transportation stocks, as you'll see in just a minute or so. But some of the key areas that really carry the market and have carried the market throughout the last 12, 13 years of this secular bull market, showing a lot of signs of wear and tear, and very, very overbought from a long-term perspective. So that's where some of my worries come in. Not so much because I think the conditions are horrible. I just think that the market probably is priced in perfection. And I don't know that we have perfection as we go forward. So anyhow, let's take a look at some of the numbers this week. So let's jump into this. So first, wanted to bring up, let me see here. There we go. Got transportation stocks. So again, this is for the entire week. Transportation stocks leading, jumping almost 2% on the week. There's your small cap Russell 2000 gaining 1.23%. Dow Jones, which still remains very, very strong. I think the Dow Jones is one of the better looking indices, by the way. Up 1.05%. S&P 400 mid cap up nearly 1%. But here's where the bifurcation comes in, and you can see some of the problems in the market. S&P 500, which is more the large cap growth and value, down 0.6%. And the NASDAQ 100 made up a lot of the large cap growth names, many in the technology area, falling almost 2%. So you can see transports up almost 2% last week. NASDAQ 100 down almost 2% last week. And this is kind of a flip of what we've been seeing throughout much of 2025. So I think some of this is going to continue. I think the rotation that we've seen over the course of the last, probably 6-7 weeks, I think this continues going forward. And so I think there are strong areas of the market. I just think the overall market itself is going to have a lot of difficulty if some of these large cap growth areas continue to struggle. Moving on to the sectors. So again, for last week, materials, financials, industrial, staples, these are areas that have a lot of value-oriented, dividend-paying type stocks. They did well, all gaining more than 1%, led by materials and financials, which both gained about 2.4%. Then down on the bottom, you can see there's the S&P 500 with that negative 0.6%. On the bottom, energy, then utilities, and lagging them all, technology, down almost 2%. Really tough week for the semiconductors, and we'll talk about them just a little bit later in the show. Moving on. So we got the Fed announcement. This is what changed in the Fed statement. And in this very first paragraph, it said previously, and the unemployment rate has edged up but remained low through August. So they kept, and the unemployment rate has edged up, but they got rid of but remained low. And you have to understand that these words, every word means something in these statements, and the market picks everything apart. When I look at that and I say, okay, they are now acknowledging that the unemployment rate has edged up and it no longer remains low. If they thought it remained low, they'd leave the wording in. So that's telling me that they're a little bit more concerned that the unemployment rate is moving up. But after cutting rates, you can see down here at the bottom, there was actually dissent. There was only 9 of the 12 voted for this quarter point cut. One, which is Stephen Moran, he actually wanted to lower the target rate by 50 basis points instead of 25. So clearly he's on the very dovish side. And then you had Goolsbee and Schmidt, who both preferred to keep rates unchanged. So there's still this dynamic on the Fed, and we've got 3 more meetings under Fed Chief Powell before his term is up as the chief. And so I think part of the problem for the market is trying to figure out where the Fed's going to go, because there's no unity on the Fed. There's this, the Fed is bifurcated. It's like some want to be dovish, some want to be more hawkish. And then you've got some in the middle that are kind of following along with Fed Chief Powell. But if you followed the Fed for many years, you know this is not normal for having all this dissent every time you have a meeting. And normally the Fed chief rallies support among his troops. That has not been the case under Powell, and especially of late. So we'll see how everything plays out. But I think the market, even though we had an initial reaction on Wednesday, even into Thursday, moving higher, I think the fact that they're acknowledging that unemployment is no longer low, no longer remaining low. And I don't know if you saw, but on Thursday, initial jobless claims jumped unexpectedly. If folks start talking about that R word, recession, that kills growth stocks. And I don't know if that's what's going on right now, and that's why money is rotating away from growth. But money is rotating away from growth. It's rotating away from the risk-on areas. That's what sustains and drives bull markets. So we've got to be careful. If Wall Street and all the big firms are moving away from those stocks, we've got to at least recognize it and understand that the risks are elevated of being in this market right now. I think long-term we're fine. I want to really be clear about that. Long-term, I'm bullish. I am talking about the next few weeks to the next few months, maybe even the first half of 2026. I don't know. We're going to see how it plays out. I want to continue to watch the action, but Wall Street is not exactly betting that this market's going to keep going higher. And if the big firms aren't betting on that, I don't know if you and I should. Anyhow, let's just keep moving. I want to take a look at the S&P 500 here. You can see we moved up. There's that 6,900 close. So Thursday, all-time high on the S&P 500. What could possibly be wrong? Well, I will just point you back to the fact that I went to all cash at the end of January of 2025, and we had an all-time high 3 weeks later, and look what happened after that. I'm not saying we're going to have a repeat. I'm just saying the risks are elevated. That's exactly what I said back in January and February, and I'm saying the exact same thing now. Risks are elevated. Are we going to have a big sell-off? I don't know. I wish I could tell you. Nobody knows. But Wall Street is acting as if Wall Street's got the cooties right now. You know, the market is not, don't want to touch it. So I don't know. We'll see how it all plays out in time for sure. S&P 500. So let me give you my sustainability ratios. Here we go. We got the S&P going up. All of my sustainability ratios were going up. That's perfect. That's what I want to see. These are all telling us that the risk-on areas of the market are doing well as the market goes up. That means that the rally is sustainable. Good. That's perfect. Golf clap. What about what's going on now? We just went back up. I just said Thursday we set an all-time high. What are our ratios doing? Well, right now, QQQ versus the spider took a turn down and approaching what would be about a 3-month low. Wait a minute. The S&P's just ready to break out the all-time highs. Yet the large cap growth index, the NASDAQ 100, underperforming. You should be scratching your head. Why? Discretionary versus staples, well off the high. And one thing certainly keeping discretionary up right now is Tesla. Tesla rallied on Friday in the face of a lot of weak growth stocks. Tesla went back up. Tesla's not far from breaking out to an all-time high. Tesla could help the discretionary area for sure. Let's keep rolling though. Look at large cap growth versus value. So we had this beautiful rally in the S&P 500, went all the way back up, set a new all-time high. Growth versus value barely budged to the upside. And then Friday, we had a big down day, and look what happens. We break down. This is not action that you typically see right before a big move to the upside in the S&P 500. Just saying. You come down, here's another large cap growth versus large cap value ratio. Breaking down. Here's mid cap growth versus mid cap value. Again, very weak bounce and about down to, this would be about an 8-month relative low. How about small cap growth versus small cap value? A week ago, I said this was still the one area that still looked good. Look at small cap growth getting crushed here over the past week or so. So things, in my opinion, actually took a turn for the worse last week, even though we got the nice 25 basis point cut, got a little bit of QE. Why are we getting that QE, by the way? Why is the unemployment rate no longer low in the Fed's eyes? Makes you wonder. And yet you still have some Fed officials dissenting. They don't even think we should cut rates. So you can't make this stuff up. You got a big something brewing in the Fed. And at the same time, we've got the market not willing to commit to riskier areas. You got to be careful out there, folks. IWM, this is a great area of the market. Small caps broke out to all-time highs. They are not impacted by those large cap growth names. And you could tell throughout the week. Friday was a weak day, but we're still in breakout territory. I would suspect the rising 20-day moving average will support any further pullback on the IWM. Looking at areas within the market, the various industry groups, this is for the last week. Gold mining, money still rotating into gold. I don't like it long term, but it's hard to argue short term as long as it stays in an uptrend. Gold mining outperformed the S&P 500 by almost 8% this past week. So money still rotating there. Recreational services, great week. I think if you look at the absolute chart, though, there was a double bottom breakdown. It's coming back up to test that. I'd be careful with that area. I don't trust it. However, there are some areas that I do like. Aluminum, I think, is very, very solid. Consumer finance is solid. Let me show you a couple of these. Here's aluminum. This doesn't look like anything bad. We had a double top breakout, been trending up above the 20, which is above the 50. Any kind of a pullback on aluminum stocks back down to about 145 or near that 20-day moving average, I think is great reward to risk entry. How about steel? Another area within the materials group. We had a breakout above the October high earlier in December. We pulled back almost to the 20-day, and we're breaking out again. PPO breaking to a new high. I mean, I think there's another area of the market that looks great. How about consumer finance? Consumer finance, multiple tests trying to get through 810. I remember talking about this back at the end of October, saying if this group could get through 810, I thought it could run. Never could get through. You could see that overhead resistance pulled back, went to a, kind of continued that consolidation that we've seen for about 7 or 8 months. Thursday, when the market broke out, consumer finance was one of the areas leading it, and it broke out above that 810 level. And even with Friday's weakness, look at that, continued moving up. This PPO just breaking above the center line, looking very bullish, momentum accelerating to the upside. So here's another area. So my point is, while I'm not a fan of the overall market, there are pockets and areas where you can still consider trades. I would just make sure that my stops are fairly close to my entry point. So I want to get these stocks on pullbacks within some of these areas I've talked about, or any other areas breaking out the new highs and looking solid on their PPOs. When they do pull back, you get 20-day tests. I think there'll be some opportunities within those groups. All right, if you're new to earningsbeats.com, go over and start your no-cost trial, 30 days for free. You do have to provide us your credit card, but we will let you know before your 30 days is up. Also, we've got a big event coming up at the beginning of the year, our Market Vision 2026 event. I'm going to give you my forecast for the entire year, not only where I think we'll be at the end of the year, but I'll kind of give you a forecast of during the year, how I see the S&P 500 moving. We've done this for 6 years in a row, last 6 years, and I've provided some really stellar forecasts. I'm proud of those forecasts. I think when you combine what the market's looking like, the signals that Wall Street's sending us, and you can use a great big dose of perspective and look at a big picture chart, I think calling the market is a little easier than a lot of people think. Anyhow, be ready to join me on Saturday, January 3rd for that. We'll be talking about that more often. Also, I want you to sign up for our free EB Digest newsletter. No credit card required. It comes out twice a week. All it takes is your name and email address. You can join tens of thousands of other folks that have joined our EB Digest. And this week, starting on Monday, we're going to be talking about a free event that we have coming up next Saturday. So Saturday, December 20th, also starting at 10 a.m. Eastern. This is going to be a free event. I'm going to start talking about a possible correction and some of the things that we need to be watching. So please make sure you sign up for the EB Digest. You will need to register for the event next Saturday, and the registration will be open starting on Monday. So please make sure you sign up for that EB Digest. Also, if you enjoy these videos, make sure you like our video. That certainly would help us on YouTube with the algorithms. Subscribe to our channel. We have a lot of these free events. When we do have a free event, live streaming on YouTube, if you're a subscriber and you turn your notifications on, you will be notified when we go live, so you can join us. All right, let's keep moving. So semiconductors, this is the area that I really think we got problems with. And unfortunately, semiconductors are the most influential area of the market when it comes to driving the S&P 500 and the NASDAQ 100. I believe the latest numbers are the NASDAQ 100 is represented about 25% by semiconductors. And I think the S&P 500 is like 12 or 13% semiconductors. So when this group struggles, it's hard for the S&P and NASDAQ to shake it off. It has a significant material impact on how the overall indices do. So if you trade the spider or you trade the QQQ, you need to be aware of what's going on with semiconductors. Let me just tell you, yes, the S&P 500 moved up, set a new all-time high on Thursday. Semiconductors were moving up, but we never got close to the high we saw back at the end of October. And look at the end of the week. When we set the all-time high on Thursday on the S&P 500, semiconductors had turned lower. And on Friday, the group was down 5.3% just Friday alone. Now, the scary part is, first of all, when you consider how far this group has come up, you know that there's downside. And might be significant downside. On a weekly chart, you can see the 20-week moving average coming in just above 26,000. Watch that level, because if we lose the 20-week moving average, that is going to be a problem for the semiconductors and for the overall market. But maybe the worst of all is right here on the semiconductor index, higher prices, lower PPO. I'm going to actually go in. I want to show you my article that I wrote at Stock Charts yesterday. And because I wrote about this, so I'm not going to annotate. I can just show you. So here is my article. Will semiconductors be a problem in 2026? And so as you go down here, I want you, there's the negative divergence I talked about. But more importantly, I look at these red shaded areas. You see when the semiconductors are really weak? These same red shaded areas are down here on the S&P 500. So when the semiconductors are going down, you can argue with it and stay in the S&P 500 if you want, but you can see how influential the group is. It takes the S&P 500 literally on its shoulder and drags it to the downside, the same way it drags it to the upside when the group is hot. So we got negative divergence, and this is a really critical part right here. So do you see these vertical lines? This is when we move from the RSI being overbought, the monthly RSI coming down below 70. That's where these lines come in, right as we're going below 70 from very overbought territory. So as we dip below, that's when you can see the S&P 500, well, you can see the semiconductors and the S&P 500 both taking a hit. Now, we have a negative divergence, and right now we're coming down on this monthly overbought. We haven't even crossed yet. Also, notice on this monthly chart that the month of November, we put a lower low in for the first time since that April low. So it's already starting to wobble a little bit. It's got a negative divergence. And we saw what happened when it turned lower in a big way on Friday. It took the whole market down with it. This is the group you want to keep an eye on. I just want to mention that. All right, AVGO, Broadcom reported earnings on Thursday after the close, beat top line, beat bottom line, and you know what happened? Dropped 11.4%. That's kind of what starts to happen when a group is toppy. You start seeing really good numbers and poor reactions to them. So again, another warning sign coming out of that space. Software, I've talked about software. I want to show you this. I want to annotate this. We'll get ready to wrap this thing up. Right here, you can see support. You can see support here twice. You can see support here, and then we lost it. Where did we bounce to on software? right to the point where we broke down. Broken support becomes resistance. That is technical analysis 101. Broke down in software, rally. This is another really important area of the market. So we've got a very overbought semiconductor group and a broken down software group. That combination is going to make it really difficult for technology, and technology is 35% of the S&P 500. So just saying, these are some areas you need to keep an eye on. Now, last group so far, internet stocks, another very important area of the market, still holding up, holding on to its rising 20-day moving average. And I just want to point out, from a seasonal perspective, internet stocks love the month of January coming up. So after the next couple of weeks, we'll be moving into January. This is a seasonal chart of internet relative to the S&P 500. So what this is telling us is that of the last 13 years, 12 of those years, internet has outperformed the S&P 500 to the tune of 4.1% average outperformance. This is a really strong group in January. So if it can continue to hold up technically, just keep in mind that we do have maybe an area that'll help to support the market in January, so long as history holds true. Anyhow, that's all I got for you this week. Be careful out there. That's probably the biggest takeaway right now, is I think the risks are elevated. We're starting to see a little crack in the foundation in the semiconductor area, which could spill over into the overall market. Have a great rest of your weekend, everybody. We'll be back next week. Happy trading.